Sports right now that just launched their inaugural one tonight. So, oh, you already hit it? Okay. And we're live on YouTube. So welcome to everyone who is joining us on YouTube tonight. So again, we are the Investors Performance Group. We are a monthly meetup that comes out and talks about real estate and how we can build your wealth. Now, we're going to dive right into it today. And of course, technology's not working. There we go. So the Investors Performance Group is proudly brought to you by the Kelly Fry team. We are, of course, a full-service real estate investment team. All of you guys know me here, but those watching online, we are here to basically service you guys from Squamish out to Hope. We've got places out in Hope right now for sales. So if you guys are looking for cash flow in the Lower Mainland, we do what we can to help you guys find it and help build wealth out this way. And our sponsor tonight, we're very excited to have Christian Dye from Latitude West Financial is sponsoring, so you can thank him for all the food. Let's give him a round of applause tonight. And we're going to have lots left over because, again, I didn't realize we're competing with another group, so make sure you guys grab some food on the way out. We're going to go into it right away. We've got some really exciting speakers, including Christian today, that are going to be a little bit of a different take on what we typically do. We are, of course, going to start it off with the market update, what's actually happening out there in the market. And there's some interesting things that are happening in the different market segments. So we're going to talk about it. Then we're going to bring up our first guest, Fernando, who is coming to us at a bit of a different angle, talking a little bit about foreign exchange. So that's going to be a very interesting conversation on how it ties into what you're doing with real estate. Then we're going to go into our Tales from the Trenches, show some hot deals that we've just got hot off the press, and then we've got our keynote speaker who's going to talk to you guys about how you can actually break through the wealth ceiling and build wealth using real estate. And of course, we would love you guys to participate, take photos, take video, post it on social media, tag us at Kelly Fry Team. We'd love to see it. All right, let's talk about what's going on in the market. So the big word that I've been using for the last month or so is the term frothy. It is definitely frothy out there. Some things are definitely moving, other things not so much. So it really depends on the market segment and what you're looking at. But in that case, we'll talk a little bit about the opportunities that it creates. So first and foremost, from the real estate board, housing market sales slowed again in August despite 2 rate cuts. Well, that was not expected, right? Everyone talked about how as soon as rates come down, we're going to start seeing buyers entering the market. I mean, I definitely felt that that was going to happen because we've seen it in the past. And while we haven't necessarily seen that trajectory start to take off yet, we just had our 3rd rate drop. So we'll maybe start to see, now boots on the ground, before we dive into the numbers, boots on the ground, I can tell you, we are definitely starting to see it's getting a little busier the last couple of weeks, but we have to wait to see how, our team, you know us, we're always busy. So we got to see how that actually translates across the whole industry. So taking a look at the supply side of things, we've got a little bit of a good news. In the month of August, we did see a little dip in the inventory because we had a massive rise in the amount of listings that were going on the market. So seeing a little dip definitely helps that we're not having as much inventory. However, when we look at the sales, you're going to note a huge discrepancy. So currently in the Greater Vancouver board, there was 13,671 listings in the month of August, which is up significantly over last year's 10,192. Fraser Valley was up to 7,537, and Chilliwack District, not a huge jump compared to last year, but it is a smaller market segment, right? When we look at the sales, though, this is where we start to get a little concerned in some regards, but we got to kind of start thinking differently in this. When we see this, the news is going to talk about it. They're going to say, oh my God, sorry, that's average price. It jumped a slide on me. Where's my sales? Come on. Inventory. Is it out of order? No, I think it's out of order. Uh-oh. Uh-oh. All right. So sales, this is where we're starting, the media is going to start to talk about the concern, what's going on. Sales have dropped significantly since the beginning of the year. In fact, we only had 1,896 sales when there was 13,000 listings in Greater Vancouver, which means on average right now, we're at about a 14% sales to active ratio, putting us bordering a buyer's market. Now, certain market segments, as we mentioned, if you start really diving granular into the numbers, you're going to see some market segments are already in buyer's markets, and other ones are still closer to seller. It depends on condos, townhouses, that specific city. Are we looking 1-bedroom, 2-bedroom, 5-bedroom houses? We also see sales are down to only 1,000 in the Fraser Valley and 227. It's actually up in the Chilliwack District area, so a little bit of different. That's where we say we don't have a Canadian real estate market. Now, if I go back a slide, you can see the impact that the sales and listing dynamic is happening. There we go. Obviously, we have seen prices in some areas start to come down, such as the Greater Vancouver market. The average sale price now sitting at 1.252. So as we continue to see less sales and increased inventory, it is going to slowly drive those prices down. Now, I don't see it really dipping. Like you can see over the last year, we've had some ups, downs. It's kind of just coasting along. We're not seeing huge drops. But as long as we sustain a low sales to active ratio, we'll continue to see a bit of that price drop. Now, whereas the Fraser Valley, we saw a little bit of an uptick over the last month. It did come down a bit, and Chilliwack has come down a decent amount, but it's still up over last year. So that's kind of what we're looking at right now. Now, as investors, we got to take this information and we got to look at, okay, well, what does that create for opportunity? If we're in a buyer's market, what should we be maybe thinking about doing? Buying, right? Because now's the types of markets where you can actually negotiate and get prices under contract for less. You can, checking a comment there. You can possibly get longer close dates. You can do a lot more with markets like this because sellers are in a little bit more desperate of a situation. Now, taking a look, we're going to kind of go from out east into Vancouver, taking a look at some of the submarkets. Chilliwack, we have seen prices are up over last year by about 13.9%, but it is down month over month. When we look at what we were presenting last month, it was closer to $1 million. So while it's up over last year, we are seeing it slightly coming down. Listings have dropped a little bit in the detached, but it's up in the other categories. We are down in price in condos. Townhouses are up 10%. Abbotsford market, again, down month over month, but it's up over last year. So we have seen some gain due to that stronger spring market that we had. Townhouses down slightly, condos pretty stable. Inventory up across the board, and days on market are increasing as well. It's taking over a month to sell. Mission market, it's down 12.4% over last year. Inventory is increasing across the board, except for condos. Condos are down about 43%. So this is a market that doesn't have a lot. So a shift in fluctuation of inventory can drastically impact it because it's predominantly a detached market there, but down across the board. Langley, up in the detached, down in townhouses very slightly, almost minuscule, down in condos. Inventory, again, climbing across the board over last year. We are seeing it's going up. We're still looking for directions to find a place. Maple Ridge, down across the board, 7.8% in the detached market over last year. Inventory, again, climbing quite drastically, especially in these two categories, the attached market. Now, one thing I'll say about the Maple Ridge market is similar to Langley in a way, because there's a significant amount of development that's happening in the condos and townhouse market there. What we do tend to see is that as projects start coming closer to completion, we see a flood of inventory in the form of assignments. So when we're looking at listings, that is including a lot of people trying to flip their contract. And if anyone bought in 2022 and is now looking to assign, they're not in as strong a position as they used to be, especially with the increase in inventory. So that's why we're seeing a lot of those numbers really start to hike up. And it's going to create some pressure on the values as well, because they're going to be dropping, trying to offload their units. We might see some fluctuation there. Saying that, well, then a month later, once the building closed, we'll see the inventory drop because suddenly 20 or 30 listings will come off the market because they've closed, and you'll see maybe a few people trickle back on into the market as well. Surrey, up slightly in condos and townhouses, barely unnoticed. Townhouses. Condos are down 4.2%. Similar story. Inventory is significantly spiked. And then we go and take a look at the Vancouver market. Again, not a lot of people, obviously, from an investment standpoint, are buying there for cash flow, but people are buying there for different investment strategies. We are down slightly on the Vancouver properties. We're back under the 2 million mark at 1.920. We're up on townhouses and basically flat on condos. Inventory risen across the board. So that is the story there. That is the numbers. We are seeing inventory increasing, kind of flat in some areas. Might be up, might be down, depending on last year's numbers. But that's where you want to look at the month over month over month. That's what we showed at the beginning, the fluctuations that we saw. What we see here in this market today is, depending on the investment strategy that you are looking to do, there is opportunity because of the amount of inventory. You can be choosy. You're not competing with other buyers. We all remember 2021, right? You know, you wanted to buy an investment property and you'd go in and you'd run your numbers and, okay, I can pay X amount of money. Then you get there and some jackass pays $300,000 over and you're like, how do you get financing for that, right? People did. We're not in those scenarios anymore, so you can actually go in, try your offers, see what happens. But the key thing as investors we need to remember is we have to be unemotional when we're making those offers, right? It's based on the numbers. It's not based on, I really want this property or not. Big mistake I had several investors make is they fall in love with the property and they have to have it, even though the numbers don't make sense. So you gotta look at the numbers. Okay. That is the market update. We're going to bring our first guest speaker up here, which is Fernando. Fernando is a foreign exchange broker with over 10 years experience. And we thought this would be kind of interesting because obviously our market here in Greater Vancouver and Fraser Valley is getting more and more difficult to cash flow. So people are starting to look at other markets. Well, what happens if you have to move money around to different markets? That's where someone like Fernando comes in. He specializes in building strong client relationships, delivering tailored foreign exchange solutions. And with his expertise, he helps clients in building strategies for foreign currency, mitigating risk, their finances, and hedging their foreign exchange exposure. So without further ado, let's bring up Fernando.
Thank you.
Thanks for coming in. Appreciate
Thank
it.
you for having me.
I'm going to wire you up here so you can clip that on wherever up here. And this is,
Cool.
There you go, all yours.
Thank you. Thank you, everyone. Yeah, my name is Fernando, and I've been, just so you guys know, I've known Kelly for about 13 years now. I did a course on investment. I have no clue right now what the name of the course was. Yeah, there was a few of them, and Kelly became a good friend and a coach at the beginning. I did not go into the path of investing for many reasons, and at that point, I was actually starting to go into learning more about just foreign exchange brokerage. And I've been doing that now for 10 years, and I've worked for 9 years for a company that was GPS. Sorry, I work for GPS Capital Markets today, and I'll talk a little bit about GPS. And I've also worked in the past for Firma Foreign Exchange, and then it got bought and it became OFX, if some people can know those companies. But it's been a great journey to learn about foreign exchange. A lot of talks, of course, are right now with people buying properties or buying in Vancouver, money from China, money from the US, money from other countries. And I've actually been lucky enough to help a lot of investors to just do a lot of different strategies, I guess, or more importantly, save some money. So today I'm just gonna talk really quick because I know I met you, Wendell. Yes, and of course you've had business in the past with the brokerage firms. So some people know about broker firms and foreign exchange, some people don't. So I'll just talk a little bit about that. And GPS Capital Markets is a company that's headquarters is in Salt Lake City for 22 years. And they really capture a lot of the market in the US. They have offices in Australia and in Europe, in the UK and Canada. So one of the biggest things is, I would say 75% of business is with corporations. It's strategies, hedging, seeing how we can help those companies protect, of course, the money that they're putting in a project and not have to wait to see where the market is going to go, what the dollar is going to be doing, et cetera. So we specialize in that, but at the same time, we can always do what I call just individual exchanges. And some people know that they can do it, or some people use Vancouver Bullion, other companies out there that they can do cash transactions. We don't deal with cash transactions. We only deal with I guess wire payments, and just everything is automatic in terms of the way that we process the money. So we are regulated by FINTRAC, of course, and at the same time, we've just worked with major banks all over the world. So that's kind of like for me to tell you that it is definitely not a small brokerage firm that it just started a year or 2 years ago. So we have done every year we do about $40 to $50 billion in exchange as a global company. And Canada is a specific market because there's a lot of investors, and especially here in Toronto, and we can help investors. Even if they're just buying one property, or if they're buying, consistent properties along the year. So there's a few processes that people need to go through that. But if you guys have questions, please, you can raise your hand and I can answer the questions. One of the biggest things for me is, how can I help an investor? Well, most investors right now that I'm seeing is they are buying properties in the U.S., Mexico. That's the ones that I've met. That's people that locally I've helped with. And to be honest, it's a simple, in my world, it's a simple transaction. You need to open up an account with the corporation. That could be an individual account, or that could be a corporate account if you're incorporated, or sole proprietor. And when you do that process, I brought some, what do you call this? Well, we call them forms just to set up, so you guys know the information that we need, just corporation information, individual information. And then we just need to pretty much, in our back office, just check that everything is for that business that you're saying you're gonna, if it's a property you're gonna buy, of course, we're gonna verify that if it's corporated and if that's what you're doing in business. For us, what we wanna do is two things: help you take that, I guess some investors that I met, they don't really care. They just want the money exchange and they just want that deal to be done. Some really care about the exchange, and of course they're looking at it every day, and it's like, oh my gosh, today is this, hopefully tomorrow is this. So what we want to do is just really help in that process to save money, because we can give you better rates in the bank. Just that's how simple it is. We can give you rates that, it's always different, so I'm not going to talk about numbers, but I will talk about average. 2% to 4% is what banks usually charge. And that's just average if you're going into a bank and saying, I need to exchange. So of course, in our case, we can give to investors, we can give 0.75 to 1% exchange rate. And I'm talking about US dollar to Canadian dollar especially. But in that, we can give you a better rate. And if you have planning to buy and you're not buying today or tomorrow and you don't need that money really quick, we can also go into what's called a strategy of hedging strategies, where we can actually tell you and talk about what would be a good rate for you. Where would you want to lock a rate? We have forward contracts as well that we can do for investors. So all of that is just conversations that we can have and set up. If the rate hits a specific time of the day, we can lock it in at the rate that we talked about. So you can save that way too. The biggest thing is fast transaction, where I had several investors where they were buying properties here in Vancouver and they had the money in Australia, and also vice versa. So what they needed is money really quick because they wanted to lock in, deposit first or lock in the whole purchase. And the way that we do it is they would send the money to our local, in this case, Australian bank, and they will wire the funds to us and to our bank account. And then we don't bring the money here to Vancouver or Canada. We just leave it there in our account, and then we deposit here the next day. So those transactions we can do in the US, of course, Mexico with the Mexican pesos, and all over the world. There are exceptions, of course, like right now Russia, and I won't talk about China because it's not my expertise to tell you that I can bring money over here. I always answer with, if you can deposit into the Australian bank, if you can wire the funds to a UK account from China, then I can do the transaction. And I know there are many reasons why most people can't do it. But I do have clients here that have companies in China and have companies here that we do transactions. So, but there is a lot of policies and things that I won't get into. So one of the biggest things is with companies like GPS Capital Markets, we have 24/7 access, which means there are people that can always help you. Of course, I'm a broker, so I'll be the one helping you most of the time. And we have over 200 currencies, and we do the spot rates, we do the forward rates. We definitely do the hedging strategies, it's options. And that's a whole new world for larger companies. So I won't talk about that, but we also, if you know companies that are already doing foreign exchange, we can also help those companies. Companies as big as Lululemon. There's a lot of clients that we have that are large companies. So this is just a little bit of history, and like I said, it's been over 22 years, over 1,000 clients as corporations, and really the fact is that some people, when it comes to investing, they don't either think about foreign exchange as a strategy or as people just don't think about it. They just say, I need to do it, so I have to do what the rate is, right? And if you do it with time, if you know someone that is actually doing those purchases, and we were talking about today, some people, if you're buying properties in the U.S. and you already have accounts in the U.S. or in U.S. dollar in Canada, some people don't exchange the money right away. Some people keep it in that, and we can do that as well. Just do a transaction in U.S. dollars to a U.S. dollar account. So if you have U.S. and you're buying in U.S., we can do those transactions faster than the bank. And typically, it's always, we don't make any money, but at the same time, we like to build a relationship with clients and help them do those transactions. So those are things that I pretty much wanted to talk about. If I'm going to probably just put this and just have people have one or just read it over. Those are the setup accounts. We do all the setting up. We just need the information. And, oops, I think I passed mine, sorry. Yeah, and if you have any questions, please let me know. I have also my business cards here, which you can grab one and pass it on. And I don't know if you have any questions right now specifically, because I know that most people, this is something that they're either not too focused on, or they're just doing it with the bank, and this is something new for you. So if you have questions, I can definitely answer any questions. You're dropping all the money.
Does anyone have any questions right now?
Yeah.
So, Fernando, I'll get you to repeat the question back just so people
Okay.
can hear on the
Sounds good.
So if there was somebody wanting to buy, let's say in Mexico,
Yes.
and then they had Canadian dollars,
Yeah.
and then you could help with that transaction over here because you could help the exchange so that it pays into the Mexican
Correct.
just faster, or is it you get a better rate? What's the advantage of going through you guys?
Yes. So the question is, as an example, if you're buying property in Mexico, what's the benefit of doing it through the company, like a brokerage firm? So yes, you're totally right with both. One is fast, and what I mean fast is, like I said, the next day, within 24 hours, if you deposit the Canadian dollar wire payment to our company, we would deposit 24 hours later into Mexico, right? In Mexican pesos, right? Obviously, that is a transaction that most people see or do in the banks, and you don't really know how much it costs, and you just send it. Well, like I said, 2% to 4% is what typically bank will charge you.
Like 4% of the amount that you're transferring.
Yeah. Well, of the exchange rate. And so, whatever the exchange rate is, a flat rate, what we call the market rate, then banks usually charge 2% to 4%. What we charge is between 0.75 to 1%. And that is where you would save a lot of money. Yeah, because it would cost you less, I guess, to send Mexican pesos. Yes?
Just trying to understand, because if you're using the option strategy,
Yes.
if the market moves in a different direction, then someone's going to take the loss, right? If you are the option writer,
Options, yeah.
then the writer is going to have to pay for that.
Yeah, so with the question is if you're, who's going to take the risk with an option?
Yes, because usually if I'm buying the
Yeah.
Foreign currency, I'm going to be paying the options premium, right?
Yes.
So on the other side, who's on the other side? Is it the GPS or?
Yeah, it's GPS, yes. And there's always, the way I see options, just so you know, it's more of a hedging strategy, of course, is there's always the leverage, right? That you have a specific rate where you would grab if it goes over that, or there's conditions if it goes, we call them a barrier, and that risk we would take. We work with major banks. Of course, we're trading with major banks, and that's why we can give a better rate. So a GPS will take that risk because you have an option not to take that trade.
So if you're not buying foreign currency, then there's no value for investing in foreign exchange. Is that true or no?
Well, the question is, sorry, can you repeat the question? If there's no value?
If you're not buying, actually, buying, doing the foreign exchange transaction, if you're not buying, let's say USD, or if you're not buying
Yeah.
Mexican pesos, then you're not, there's no way for you to get into the market. Is that true or no?
So if you're buying pesos
Yeah.
and there's no way for you to get in the market, just in case. So the reality is I don't deal with investors of, just like what they call daily trading. But there's always a thing about what I call taking your heart into the deal and just looking at why you want to do a transaction, right? If you're buying a property, of course, that's the main thing you want to do, right? And that's why I've had many clients that what they're doing is buying a property. Now you want to just exchange and trade for yourself to keep money in other currency, which is a different story. But I always recommend is have a set, like today, obviously the rate has been going up and down because of the U.S. Fed cut for the first time in the U.S. the interest rate. So, if you have that attachment, I think that's where you could just be all over the place. But if you set a rate where I would buy U.S. dollars at this rate because I want to do whatever with the money, that's when we can work. And that's where I can help you save money. Because if you already have a rate where you would like to buy at, then we can put strategies to make the best for that. I hope that answered your question.
Yeah, thank you.
Yeah. Yeah. And like I said, I mean, this is something I guess a new topic for most people in this world. But I've had several friends and also companies that have referred me to investors. And they just buy one time, properties in Mexico, and like I said, vice versa. So a Mexican investor can also, we could help because they can deposit into our Mexican peso account in Mexico, and of course put the money here. So if you also know people that are, buying properties here from other countries, we can also help. And everyone had a business card, so you guys can contact me or send me an email. But thank you for having me. And if anything else, I'm happy to help anyone that has more questions after.
Awesome. All right.
Thank you.
Thank you. Appreciate it.
Yeah,
I'm going to
of
grab
course.
the microphone back from you there. Perfect.
Perfect.
All right. We definitely wanted to kind of mix things up a little bit because obviously we're starting to see a lot of people talk about other markets right now. We've got friends of ours that are selling in Phoenix to Mexico to, I had a friend of mine out from Portugal talking about the Portuguese market a few months back. So people are starting to look for alternative investment areas, especially if you've been investing here in the Lower Mainland and you're starting to struggle between costs or cash flow, right? So having someone like Fernando who is a resource just to be able to move the money in a quicker, especially if you find a really good deal and you got to move quick, you got to be able to have that money available to make deposits, to be able to close on properties. So that's why we thought we'd bring Fernando out. And I mean, very interesting stuff because moving money is, it's not simple, but it's easier than it used to be now. So having someone like Fernando out is a great resource. So we're gonna continue forward with our Tales from the Trenches. This is a segment that we do every single, I don't know what's happening here. Jerry? Okay, sorry guys. Jerry, can you figure this out? What's going on? What it is we actually don't have a tale this month. First time in a long time, we haven't had a Tales from the Trench. So, and I just wanted to let you know as well, Jim Garnett, who is a close friend of ours and has been out to speak several times and does our Tales from the Trenches, he's unfortunately going through some issues right now with some regulatory, just because of the nature of the work he does to support landlords. this province doesn't like supporting landlords. So he's unfortunately dealing with some stuff, so he can no longer come and share some of these wild tales that he has. So we'll definitely be looking for on the lookout for other tales from the trenches. But this time, you guys got a break from this segment. And we're going to go right into our hot deal. Now, we've actually got 3 hot deals, but I'm only going to show you one today because I have the information on one, and I'm getting information on 2 more. Now, the first one I'm going to show you here is Inspire Phase 3 in Maple Ridge. So this is a new development by Platinum Properties. We were actually involved in Phase 1 and Phase 2. Now they're finally launching Phase 3, and we're super excited about it because it's a lovely development, great area in not too far outside of downtown, just north of Dooney Trunk. And prices are actually quite attractive in the market right now. Can you guys see over there well enough? Okay, so prices are starting at, for 1 bed, 1 bath, at $449,900. Now what I can tell you is that I've got 1 bedroom, 1 baths right now on the market trying to get above that. But what's more than that, early entry in, they're giving $30,000 off as a promo. So take these numbers and subtract an additional $30,000. So it's a great way that if you're looking to get into the pre-sale market, that you can get in for well below, in my opinion, market value for Maple Ridge right now. The current deposit structure is 5% within 7 days or after your right of rescission, and then an additional 5% either 90 days later or when they get their building permit, whichever comes later. Estimated completion on this is 2027. Now, I'm kind of liking pre-sales again right now. I was a little leery on it in the last couple of years, but what I'm liking right now is that because we are coming, through the high interest rate times, we might start to see continued, the Feds just dropped in the US by another 0.5 basis points, right? So if we continue to see that, that will eventually start creating some waves of buyers. It's been slower, but at least with this, it gives you 2 years. Plus, if you're buying it at well below market value, you're building it in with a little bit of a hedge in case anything goes wrong. So that's this project right now. Again, great little area. This is kind of the downtown area of Maple Ridge, if anyone's familiar with it. We are just north on 223rd and Brown Avenue. Lots of new development going in that area. You've got Era, you've got Edge, you've got Inspire. There's the Thomas Haney is not too far away. That just closed. So lots of development happening in that area. You're right close to shopping. You're right close to the recreation center. Everything transit-wise, you've got the bus loop right there. And it's not too far from the bus, or if you want to take the walk all the way down to the West Coast Express, you're about a 15 to 20-minute walk to the West Coast Express. So that is the Inspire. Now, 2 more hot deals, which I don't have the details on yet, besides the fact that I'm getting the details. One, I have a meeting tomorrow with a project marketing company. They're coming to my office to talk about a project in Princeton, BC. This is one of the first major developments that Princeton has seen. But what's attracted me about this, at first I was like, Princeton, okay, cool, is the fact that Princeton's population is so small, it actually falls outside the new Airbnb regulations. So you can actually still do Airbnb in this market. Now, the question that was proposed was like, okay, well, what happens if they start developing the city and the population rises? Well, they need another, I think it's like 10,000 residents to get to that threshold or something like that. And this is only 150 units. It's going to take them a while to get to that point. But the prices are super attractive, starting at around $250,000. So I was like, okay, there's some opportunity potentially here. So I got them coming into my office tomorrow, so we will send details out about that once we have it, as well as some townhouses in Powell River. We're getting connected with a developer up there. They are developing about 4 or 5 phases of townhouses, 3 bedrooms, 3 bath, starting at around $499. And according to them, they should rent for in and around $2,500. And again, we're going to look at the numbers, we're going to crunch those, and if it makes sense, we'll fire it off to all of you guys. So those are 3 different hot deals. This one available pretty much immediately. The other 2 should be coming in the next 3 to 5 days. And with that being said, we're going to go right into our keynote speaker, Christian Dye. Christian is an award-winning educator and founder of Latitude West, specializing in building wealth for clients through active and passive real estate investments. His practice offers traditional financial planning and analysis of cash-flowing real estate deals with a strong focus on client education. And he's built his own wealth through real estate and recently published Break Your Wealth Ceiling, which he's got a couple copies of the book here today. So without further ado, I'd like to bring up Christian.
Sure, thank you.
Thank you so much. Again, we'll hook that onto you for the online folks, and that is all yours.
Okay, let me Yeah, thank you. I need the speaker. I don't have the strong of a voice over here. But yeah, thanks for having me. And I know it's a little bit later, so I want to kind of keep this interactive, keep you guys awake as well as asking as many questions as you possibly can. Yeah, so I guess my background is very, I come from education background, so I taught for many, many years. But you don't have a lot of really, really, really wealthy teachers, but I've taught with them. I've taught with people who were teachers and they became very, very wealthy. And I almost, in my early days, I sort of had them as my mentor, but I also had my uncle as my mentor. So I wrote this book that really tried to understand, can an average Canadian build an enormous amount of wealth? And the quick answer is yes, but not through the stock market, or good luck trying. And I know a few of you in this room, and I know a few of you have that same story. You've built all of your wealth through real estate as well. So what I want to do is kind of again break that wealth ceiling and talk to you guys a little bit about it. And then for those of us who have taxation issues, I'm going to give you guys some strategies on how we can minimize it. We don't want to dodge it. We want to minimize it. Grow your wealth in real estate. I started my financial practice in order to, it's very different than other financial practices because the idea behind it was to help people grow their wealth in real estate because they didn't really have a lot of options to get information. A lot of really, really good financial advisors out there, but they kind of stayed in their lane with mutual funds and insurance. There really wasn't a lot more value they can add for the true real estate investor. So what I wanted to do is, because I'm a real estate investor myself, but I had the financial planning background, I just wanted to integrate and create a practice that has the ability to help people with all of those issues. Okay, so quick little disclaimer that the advice and the examples that I'm giving today is not to be considered as investing or real estate or tax or legal advice. This is just for educational purposes and to of course use your own people to if you're going to do any changes yourself. I thought I'd kind of start with something I guess back to my teaching days to keep you guys awake, and then Cameron, I want you involved in this as well. So it's just a little activity that I'd like everyone to try to participate in. So what I want you to do is I want you to just quickly read the screen over here. I hope everybody can see it.
Read it out loud?
Nope. Just in your head. There, we got it. So what I want you to do is I want you to, in the sentence below, to yourself, don't yell it out loud and don't say it to your partner. I just want you to count the number of F's that you see, but don't say it out loud. Everybody have a number? Just don't say it out loud. Okay. So since we all can read and since everyone can also count, technically all of our numbers should be the same, correct?
Yeah.
It should be. So don't be swayed by what other people say. Just, stick to your number. All I'm going to do is ask this. When I say your number, just raise your hand. And if this is done correctly, everyone's hand should raise at the exact same number. When you guys agree? Let's try it. 1 F. Nobody. And for those of you who are watching online, maybe sort of play along here and be honest with yourself. 2 F's? 3 F's? You had 2? Okay, so one person had 2. 3? 1, 2 people have 3. 4? 1 person has 4. 5? 1 person has 5. 6? 1 person, 2 people have 6. 7? 1 person has 7. So I'm going to stop there. Notice we all have different numbers. How can we all have different numbers if we're all reading the same thing, right? And the quick answer is because we all have blind spots. That's why. We all have blind spots, even though it's very, very obvious. Okay. So blind spots aren't just in what we see, but it's also in what we do, which is why we make mistakes. In real estate, we also make mistakes because we have blind spots. But so first, let's finish this off over here. 1 person got 7, I believe. There's 7. There's 7 F's here.
So there's 7 F's here. Now, I'm going to ask this. I just told you that there's 7. I want you to read it again and try to catch all 7. I can tell by the expression that some of you got all 7, but some of you still don't get all 7. Some of you still can't find all 7. Still can't find all 7? That's a perfect example. At least we're honest. I find that it's the exact same thing with real estate. And the thing is, I've been a real estate investor for a long time, and I've been advising people on real estate investing for a long time. And I was actually just in a conversation over there where I was saying, you got to convince your son to buy this piece of real estate. It's so obvious. He's catching an amazing deal. It's capital gains tax free. He's going to have the greatest regret in his life in 2 years from now. And he's like, I don't think I can convince my son. I'm the same way. I tell clients all the time, says, this is a really good deal. You really should be shifting to investing in more real estate. No. Don't want to do it. It's too risky or whatever. 5 years later, oh my God, what a big mistake. It's because, same thing, we've got blind spots. So, I had a slide where I showed all of them. I'll point them out. So there's 1, 2, 3, 4, 5, 6, 7. There's all 7. Okay. So it's all right. I have never given this where everyone in the room got all 7. So I kind of set you guys up for failure anyway. But to prove my point, and it leads into this one. What are the 3 mistakes of real estate? And I actually added a 4th one recently. And the 3 mistakes of real estate are, and if you guys invest in real estate, you're just going to keep nodding your head as I list them out. You're just going to keep nodding your head. Number 1, I should have bought earlier. Yeah. I should have bought earlier. If you guys own real estate, you're saying to yourself, yeah, I should have bought it 10 years before I actually bought it. The second one, should have bought more. Back then, oh my goodness, I should have bought more. And the third one, I hope nobody has gotten this one. I've suffered from this one too. Sold too early. Sold too early. Yeah. Someone was holding on to a property and they didn't really have to sell it, but they sold it. Next thing you know, it kept going up. Kept going up. The 4th one I'm going to add to the 3 mistakes of real estate is bought the wrong property. Because someone may say, yeah, Christian, I bought this thing 10 years ago. It was a big mistake. It turned into a nightmare. And so my financial practice is built around avoiding these 4 mistakes, because essentially you're working with a team who knows what they're doing. They know how to analyze it, and they're also incentivized a little bit differently. I don't profit if you buy or sell real estate, but what I do is my goal is to grow your wealth and to protect your wealth. I protect your wealth from not making a mistake, but I also grow it by encouraging you to buy more. Or if Cameron and his team say, here's this amazing thing out in Penticton, well, if I analyze it and said, that is amazing, you should buy that, that's a value. There's a piece of value, and we don't have a lot of places in the marketplace where we can get this help. So, how do the wealthy invest? And this is kind of that shift that my book tries to point out. And this idea, and a lot of the people probably, you've already drank the Kool-Aid in saying, yeah, Christian, we 100% agree, but not everybody out there is doing this. And that is, I find that too many people are still investing significantly all of their wealth into mutual funds, TFSAs, a very, very traditional message that's being projected on us in the financial industry. So I'm swimming upstream just even saying this, But if we look at who are the wealthiest people on the planet, we're talking, people like pension plans. We're talking individual, large individual families. We're talking hedge funds. So Tony Robbins actually just recently wrote a book called The Holy Grail of Investing. And in The Holy Grail of Investing, what they don't do is put all of their money into mutual funds or ETFs or some sort of a balanced portfolio of an 80-20 split of stocks and bonds. They don't. The wealthiest people don't do that. So if anyone's familiar with the Tiger 21, the Tiger 21 is a group of people, it's a group of investors, and they have chapters in different areas across North America. I'm not sure if they're outside of North America. But the average investor has 100 million, and you need a 10 million just to be part of the group. It's basically an investment group. They don't invest your money, but they're just a group of people that have an enormous amount of money, and they kind of, they'll get the best and the brightest, and they'll try to understand where the trends are. Well, when they dissected the Tiger 21, something I'd just like to highlight over here is less than 21% of their money is in the public stock market. 21% is in the public stock market. You have 31% in real estate. 31% in real estate. This formula is very, very common over here, where there's a very small portion. There still is a portion, but it's a small portion in the stock market, where you have common investors, that you have your friends at work, you have, maybe your cousins and your relatives, where they have the majority of their wealth in their pension plan, and they have the majority of wealth in the stock market. And what I'm saying over here is it's more volatile, and you're not going to be poor, but you're also not going to be rich, and that's the difference over here. It's going to prevent you from, being impoverished, but it's not going to create an enormous amount of wealth, which is what my book is trying to say over here. So if this is like this incredibly wealthy, smartest, wealthy guys are only putting 21% in the stock market, why is everybody else putting like 80%? And if they're putting 31% in the real estate market, why aren't you, right? Canada Pension Plan is another really, really big one. They've outperformed the S&P 500 consistently. And if you take a look at, they're one of the best pension plans in the entire world, okay? So if you said Canada Pension Plan, where are they putting their money? Well, if we dissect it a little bit, 21% is in real estate, less than 31% in the public stock market. Same thing, very, very similar. A unique part is this portion here, fixed income. 23%, Tiger 21, 20% in fixed income. Warren Buffett has got, like about 20% of his money in cash right now. Why such large portions, right? Why such large portions? And the idea inside the book is trying to tell you why you have such large portions that's incredibly liquid. And the quick answer is, well, not only safety, but the quick answer is so that they could pounce when there's a sale. They could pounce when there's a sale. Because now we could take advantage of an opportunity. Now, the sale might be in a crash stock market, or the sale might be in an opportunity in the real estate market, right? But they can go in heavy and they can go in quickly, right? And that's where they're getting triple-digit returns when they do these types of things, okay? So it really is a matter of how liquid and how accessible and how non-correlated we are to the real estate market, how non-correlated are we to the stock market, okay? And that's how you build strong portfolios. So some questions: how can I make double-digit returns? How can I invest like an institution? And what is the best way to invest currently in real estate? So these are the questions that I try to tackle in my book, okay? And for those of you who are listening online, it's available on Amazon. They priced it a little bit high. I actually forced them to bring it down so it's incredibly accessible to Canadians. So it's under $20. It's very, very inexpensive. And for those of you who are here, by all means, we'll grab one on the way out. But I think it makes some good reading because it really goes against the grain. It goes against an argument of our child is born, and what's the first thing you do when your child is born, when you're at the bank? What should you set up? RESPs. I can think of 5 different ways for my child to get an education. There's a way bigger problem. How the hell are they going to afford a home in Vancouver? Isn't that a bigger problem than how are they going to go to school, right? But that's a real estate problem. Stocks aren't going to solve a real estate problem. Real estate is going to solve a real estate problem. If I had a child born today, I would want to hear more about your Princeton, your Princeton, what is it, starting at $299 or $399. Because in 18 years or in 25 years right now, that could pay for my child's education and pay for my child's down payment on their home. And it's Airbnb. Like, that's the way we need to be thinking. We've got a way bigger problem than how are our kids going to afford education, right? And it's the same thing, retirement. When we start thinking of retirement, if we don't have traditional pension, let's say we're self-employed or we own a business or there's no benefits, okay, inflation is going to be working against you. Cost of living, all of those other things is going to be working against you over here. But if you own real estate, and I mean multiple forms of real estate, that's working with you. As rents rise, that means rent coming in. You're hedged, right? But we don't talk about that in the schools, right? We don't look at it that way. We say, well, I went into the bank and they wanted me to, maximize my RSPs for this year. We should be maximizing our real estate. That's what we should be maximizing. If you want a really comfortable lifestyle, if you want to make sure you're not, a victim to running out of money. You see, those of us who invest in real estate, we don't run out of money in our retirement over here because our wealth keeps growing. Plus, we could leverage against that wealth. You can't leverage against your RSPs. The only thing your RSPs can do is run out. So please pick up the book. It's a good read, and it kind of goes against conventional thinking, but it's very, very pro-real estate as to why you shouldn't be using your realtor once every 10 years. You should be using your realtor once every 2 years. You shouldn't be using your mortgage broker once every 10 years. You should be using them once every 2 years, right? We should be looking outside of our own market too, because maybe the deals aren't in our local market. So my practice does very, very traditional financial planning. That's on the left side of the quadrant. Insurance and investments. But on the right-hand side of the quadrant, that's where we're more unique, especially in the bottom right-hand side. It's really understanding what can we do with your existing real estate, how can we grow its wealth, okay? And a part where we're very, very unique is it's very non-biased advice because we're not mortgage brokers, we're not realtors, but we're encouraging that you grow your wealth in real estate because that's the philosophy of our firm, okay? And that's, of course, my personal philosophy, and that's how I've grown my wealth. So should we be investing in real estate in 2024? There's a good question. Interest rates are up, prices are still high, can't find deals. Should we be investing in 2024? So I'm going to ask a different question over here. What were the worst years to invest in real estate? What were the worst years to invest in real estate? In the 1980s with double digits? Terrible time to invest. People were losing their homes. In 2008 in the housing collapse? Was that a bad time? In 2020, COVID. Was this a bad time? If you bought real estate here, or here, and you're holding on to it today, do you have any regrets? Of course not. And these were the worst times to buy, right? So there's definitely a bad time to buy in the stock market, but in real estate, is there actually a bad time to buy? Really? Like some people are looking at this and they're almost probably scratching their head and says, Christian, those aren't the worst times to buy. Those are the best times to buy. Like I bought here and here, right? So it's really more of a numbers game. And I think Cameron already expressed that. He says it shouldn't be an emotional, it should be more mathematical. Like, does this make sense? Does it cash flow? Will this capital appreciate, right? But for some people, they can't do the math, and they need help. If you can do it on your own, do it on your own. But if you can't do it on your own, you actually need assistance over here, just like we need assistance and we want specialists. So is 2024 a good year to buy? Yes. Was 2023? Yes. Was 2022? Yes. Every single year was a good year to buy. But the question was where, right? And what was the deal? They could have literally be, this house over here is not a good place to buy. The place right next door may have been a good place to buy. So it's not a matter of, should I buy in Alberta? Should I buy in, in the Okanagan? Should I buy in Victoria? You're asking the wrong question. It's really, where is something that is going to either cash flow or capital appreciate? Now, there are trends. There are some areas that are in general better deals than others, right? But the idea behind, I'll buy when the rates go down. I'll buy when it gets cheaper. I'll buy when a good deal falls in my lap. You're never going to buy, right? It's not going to get cheaper, right? Because when rates go down, housing price is going to go up. And when the rates went up and housing prices calmed down, then everyone's like, I'll wait for the rates to calm down over here. Yeah, you're going. The problem is you're going too much with where everybody else is going. That's where you don't want to go. And I have one client who's having a little bit of trouble with some of the real estate on the closing, and then I reminded him of a saying that Warren Buffett said, and he says, when there's blood in the streets, buy, even if it's your blood. And I remember this quote because back in the 90s, I had a leaky condo. And it was the first purchase I ever made. And it was $100,000 that I bought it for, a 2-bedroom condo. And then 2 years later, they needed an $18,000 assessment on it that I needed to pay because it was leaky. And on paper, it was worth $40,000. And on the free market, it was worth $60,000. So right away, my mentor, my uncle, I said, oh my goodness, what are we going to do? I own 1, you own like 6. What are we going to do? He says, I'll tell you what we're going to do. Hold on for dear life and buy. Buy, are you crazy? He says, pennies on the dollar. He says, these things are leaky. He says, don't buy the leaky ones, buy the good ones. Yeah, the bad ones are 60, the good ones are 70. Go buy a 70. And then I thought, you know what, you're right. I did the math. And back then I was still young. I could only buy 1 more. He could buy 10, you know. But the idea in 2008, same thing in the US, you know, there's always going to be these cycles where you're going to get these ideas. So what you want to do is you want to be in a position to buy. That's what you want. You want to be positioned to buy. And that's the beautiful thing about real estate investors. We're only in a position to buy if we already have real estate, because if we have equity in the real estate, we could leverage. That's the beautiful thing. We could leverage, right? And that's another amazing advantage of real estate versus stocks, especially because when we leverage, it's tax-free. When I sell my stocks, I get taxed on it. When I leverage real estate, it's tax-free. Not only that, if it's investment real estate, I actually get interest deductions on it. Okay, so let's talk about Canadian housing. Should we be buying in Canada over here? You know, will Canadian real estate keep going up? So I'm going to give you guys a little bit of a market update in terms of what's happening with immigration. 1.2 million new immigrants approved for 2024. We'll probably see about 1 million come in for sure, right? But how many housing new starts are there? Only 300,000 new housing starts. See, we're already short. Okay, down, and that's down 7% from the prior years. Okay, this over here I think comes from the Globe and Mail. Canada needs to increase new housing production by 3.5 times the current rate to meet the 2030 target of a balanced market. And then it goes on to say, this is impossible to meet this by 2030. It's actually impossible to meet it by 2040, right? It's a 20-year crystal ball saying there's not enough housing for the amount of people that are coming in. If you've ever taken an economics course of supply and demand, too much demand, not enough supply, guess that's what's going to do with rental and housing costs, okay? So housing's going to go up, so what does that tell you? We should be buying more real estate. Rent's going to go up, what does that tell you? We should be buying more real estate. We should be more landlord, right? So this whole idea of should we be buying, the quick answer is yes. The where is the tricky part, and what's the deal behind it. We don't want the fourth mistake, buying the wrong product. Just, oh, Christian said to buy real estate, I'm just going to go in there and just buy something, right? Then you can get yourself in trouble if you're not sure what you're doing, okay? So what's this ROI analysis? And I put this is straight off the book, and I think for those of us either in this room or those of us listening who are still not convinced about, you know, the investments, how can you get a double-digit return, I'm going to give you a nice math example, okay? So this over here is in the stock market. $500 over 40 years, okay? I invest $500 per month over 40 years. If I get a 4% return on my money, we'll call this TFSAs, okay? You know, your total investment will have been $240,000. By age 65, you will have had $580,000, okay? We'll call that the base case. It's not that hard to get 4% in the stock market. Now let's take the same guy, but this time he's getting 8%. That same person will have $1.6 million by age 65. That's 177% more that they have by just getting a 4% difference over here. Now, can you get an 8%? Well, that's a better balanced portfolio, probably very highly subject to S&P 500, so that you get those long-term gains over here. So a lot of people say, yeah, you know, I've got a good advisor, I'm doing ETFs, and I think I can get 8. Now 12, now we're reaching. Somebody who can get consistently 12% over the next 40 years, they should be a hedge fund manager, right? Because it's like consistently, it's very, 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 very hard. You know, even for the professionals to get that. So we can all agree, it's very hard, Christian. If anybody does that consistently over 40 years, it would be rare. It would just be rare. But look at the number. We're talking 4.8 million. It goes to show you what the difference just a couple of points can make when you're compounded, right? This is me, the math geeking out on you, right? But wouldn't it be great if the average Canadian can make this 12% but not doing it through the stock market? Well, let's take a look over here. These are a demographic I pulled from Vancouver housing prices. 30-year average back to 1990, 6.3% annual increase on the property. Okay, 6.3. Last 20 years, 8.5. In the last 10 years, a solid 9%. Okay, so this is far outside of the regular Canadian average over here. Okay, so do you believe that Vancouver will continue to do this? Go back to the supply and demand, right? Go back to the supply and demand. The only thing that will slow this down is an enormous amount of supply that's added into Metro Vancouver or a massive decrease in demand, and I don't see either of those things happening anytime soon. So we should still see prices continue to go up. Who knows, you know, but I think these numbers are very, very realistic. Some of you are looking at the numbers and Christian, it's 12, it's 17, like depending on the market. Or yeah, but if we stretch it over 10, 15 years, I'm going to stick with a solid 8 to 9, okay? So now, if I take a look at this S&P 500, and there's a great calculator where you could pick any year and then pick any starting year and any ending year, and it'll tell you what the S&P has done. So I did the same demographic, 2000, 2023, 6.93. So about 7% S&P is done from 2000 to 2023. Depending on where you take the time frame, sometimes it's as high as 9, okay? So 7 to 9 is what I think the stock market will do, okay? But you got all of that volatility. It's this crazy volatility. Negative 35%, 30, then 14, then negative. You're bouncing like crazy. So for those of you who took any stats, standard deviation is 16.5. Big bounces, right? Real estate doesn't have that same bounce. So first of all, we're lower volatility. So if anybody says it's riskier to invest in real estate than in the stock market, they're wrong just by the volatility. Just by the volatility, they're wrong. But I understand what they're saying. They can lose their shirt. They can buy a terrible property. It can deal like, you know, losing a deposit. That part is risky if you're not sure what you're doing. So if I compare the stock market over here, let's take a stock market that's growing at 7, okay? $100,000, and let's just follow it for 30 years. First of all, if you put $100,000 into the stock market, well, there's no loan against it. It's not real estate, so you've got no liability. So in year one, $100,000 is the asset and $100,000 is the equity, okay? In year 20, this has grown to almost $400,000, and in year 30, it's grown to $761, okay? Because there's no debt against it, the asset is the same as the equity, okay? So now I'm gonna take my real estate example over here. If I have the same 100 grand, that'll buy me $500,000 worth of real estate, right? 20% down payment, maybe your place out in Princeton over there, okay? Now, the trick is, can we find a property that off of a 20% down payment can support the mortgage as well as the rentals and all of that other stuff, okay? So the perfect idea is to get one break even, cash flow would even be better, okay? But let's just look at the asset itself. It's $100,000. Now I'm going to just grow it at 6% because I don't want to inflate it by using Vancouver numbers at 9. I'm just going to grow it at 6, nice and conservative. The asset's worth $500, but I put $100,000 down payment. Liability is $400. That's the mortgage. So I have equity of $100 grand in the first year. Is everybody okay? Year 20, the mortgage keeps going down because you got a renter paying it off. But the asset goes up. So if it grows by 6%, that $500,000 property will be $1.6 million. But my mortgage will only be $195 grand. Subtract it, that's the equity. That's $1.4 million. Let's go to year 30. All right, the place is paid off. It's a 30-year mortgage, right? Property's worth 2.8, no debt against it. That's 287. So let's do the math. If 100 grand turned into $2.8 million, what's my rate of return? I did the math, it's 12%. We're in the double digits. Now, if that 6 became a 9, then that number is now north of 20%. Okay? There's one number I haven't taken into account. I didn't take into account the rent. Unless this stock was having some killer dividend, this thing will blow it away on the dividend side as well because we're getting all the rent as well, right? All that rent is coming in as cash flow. The other thing I didn't take into account is this. I would say about year 5, maybe year 6, guess what I'm going to do with all that equity? You're going to leverage it and you're going to buy more real estate. Can't do that with this, right? So how do people grow their wealth so quickly, so fast who are in real estate as opposed to stocks, right? See, these guys over here, they're running a race. These guys are biking or driving in the same race. They're going to get to the same spot, but significantly faster, significantly faster. This guy's going to try to get to 721,000 in 30 years. This guy will be at 761,000 probably in year 10. All they're doing is getting there faster. They've got more leverage in order to do stuff off of it, right? So for those of you who invest in real estate, what I'm trying to encourage that you do is do more, do it faster. Okay? So how can we reduce taxation on our assets? So this is kind of like a good problem to have, but still a problem. And I know there's a couple people in the room probably have this problem, too much real estate. Assets are good, but now I got to protect it because I'm going to lose a lot of this to taxation. So I'm going to kind of put on my next roll over here, the tax bill. So I've developed a couple case studies over here. First of all, first one is the real estate investor. Married, 3 kids, owns 5 rental properties. Okay? Standard kind of maybe a Vancouver guy who's been investing for about 15, 20 years. A lot of guys fit this profile. Okay, problem, large capital gains. Maybe they've got it in the money in a holding company or a corporation, or maybe they own it personally. This particular example, I'm going to assume that they had holding company. So how can we minimize this capital gains over here? Well, that's why it's good to work with an advisor who specializes in real estate, because they also know all the financial instruments that could be used over here. So corporate estate bonds is probably going to be the best solution. And a lot of people don't even understand what those are. So I'm going to kind of explain them. But what's the goal with a corporate estate bond? It reduces taxation, it defers capital gains, you can leverage against it, and it also builds something called CDA credits. And CDA credits are capital dividend account credits. So here we call it the estate bomb, because what happens is real estate people, we don't sell. We defer. But what eventually happens, when we pass away, we have to pay the taxation on it. Even if we gift it, even if it's gifted and inherited to the next generation, we still got to pay the tax, okay? So we feel that an estate bomb is going to go off right when we pass away. And then there's rollover to spouse, but when last to die happens, it rolls over, then you're going to have this big estate problem over here, okay? So what is a corporate, why would a corporate estate bond help to minimize or solve this problem outright? And the quick answer is the CDA credit. You see, the CDA credit, what it does is it's inside a corporation, but it gets money out of the corporation tax-free. Now, for those of you who are following what the government had done in June, is they reduced the inclusion rate, but it also reduced the CDA credit. So it went from 50% down to 32%. Okay? So what that means is it's like changing the rules of the game near the end of the game. So we're making investment decisions based off of taxation, setting up holding companies, setting up corporations, doing all these other things for tax reasons, but then all of a sudden they're changing the tax rules on us midway. So again, I don't want to go into a rant, but these are the rules and we have to play inside them. Well, luckily, they didn't change the rules on corporate estate bonds. So here's my case study. Person has principal residence, but of course that's capital gains tax-free, but then they got all of these other properties over here. And each of these properties, I think they're mislabeled here, 1, 2, 3, 4, 5, yeah. So 5 rental properties. So what we do is we figure out, well, what was it purchased at and what's its current fair market value? So far that's the capital gain, but they haven't been sold yet. But now we project out what is your intention, and this person's intention, never gonna sell. Now, if anything, I'm gonna add more, I'm not gonna sell. It says, okay, well, let's go calculate your capital gains. So we take a growth rate and we take a conservative growth rate because some of these properties are not in Vancouver. Now this number is going to get worse if they're in Vancouver, but they're kind of spread out in different areas. So we use a conservative 3%, but the thing is if this thing is growing higher, then of course it'll be more. Long story short, the capital gains tax bill weighting is about 3.7 million, at minimum 3.7 million. Okay, so now we have to figure out how are you going to pay this 3.7 million. Now they have it in other assets, but do they want to pay it, right, is the big question. So one thing they could do is sell assets. So how do you pay $3.7 million when you've got taxable assets? It'll take you $5 million. So you got to pay $5 million out of selling something in order to pay this 3.7 out. But a lot of people don't like that because then the vultures come out. It's like a fire sale because these people have to pay it out because they can't get the money out unless they pay the tax, right? And especially second generation, they didn't build the wealth. They're happy to take a 20% loss just to pay out the taxes because they have to close this thing in a month or so. And that's how come you get these people with the sale. They could borrow and leverage against it, but you know that one's fairly complicated and you get this accruing interest, but we sort of calculate it's a little bit better, but not great. But then the corporate estate bonds was an earlier investment because we knew the problem was coming in the next 20 years, so we just calculated for it. And then all we did was we shifted, so this person had stock portfolio, they had stocks, they had bonds, they had GICs, and they had all their real estate. We just shifted the GICs, we shifted the bonds to corporate estate bonds. So we didn't tell them to invest new money, we just shifted old money. We just said it's going to be more efficient, okay? And so what ended up happening was this. We took traditional investment, which was their approach, invest, it grows over time, then you liquidate it through death or through a sale, and you've got a big tax bill. What we've done over here with corporate estate bond strategy is we completely minimize the taxation because corporate estate bond is bought through insurance companies. So first you've got to be licensed. And it's a very, very particular type of estate bond that comes with a death benefit. Now, in Canada, death benefit is paid out tax-free, see. But even more important is that it comes with a CDA credit. And that's a lot of things that people don't realize. They don't realize there's a big CDA credit that comes with corporate estate bonds. So what that CDA credit can do is they can help to pull out the value outside the corporation tax-free. So essentially, when we deal with clients, we just basically say, you know, who would you like to give the extra money to, CRA or your kids, right? You know, I don't mind paying my taxes. I just don't want to give them a tip at the end, right? So here, we play out, if you do nothing, and these are your, right now, this is where else your money is going, you know, we take the deposit. So the corporate estate bond, basically, we needed to shift about $32,000 annually. So they already had the cash, but we were just saying, right now they're investing it in a 4% bond. We said, let's do it in our corporate estate bond, which was yielding about 4 to 5%, but it came with, of course, the CDA credit. We figure out, you know, by the time they pass away, if you do nothing or sort of do what you're doing right now, they'd have about 1.5 million lost to taxation with their regular bonds, and instead with this one over here, they would preserve the full almost 7 million. So this is kind of the creative stuff that we do when we take a look at a portfolio and says, how can I minimize your taxation and how can I grow wealth over here? So there's one strategy is add corporate estate bonds into your portfolio. If you are incorporated and you don't understand the tax implication, here's the quick answer. Dividend paying Canadian securities are 38% is tax rate. Stocks, mutual funds are 25%, but bonds and GICs are 51% taxation. So that's why they're very, very inefficient. Having any form of bonds or GICs corporately owned and invested in is, first of all, the yield is low and the tax is high, right? So they're not as efficient. So what you want to do is you want to try to shift. Estate bonds have way better advantage, way better advantage. Okay, so case number 2, high income investor. So we deal with several, well, our practice started with a lot of physicians and dentists. And the good thing about physicians and dentists is they're very, very nice and they're reliant on people's information, but they don't have the time to research a lot of things and they tend to make a lot of mistakes, okay? That's been my history. They make a lot of mistakes. But they often are either in medical or dental school for an enormous amount of time. When they're kicked out on the other end, they just have this high income, okay, without the experience or the knowledge. So this one over here, let's say our high income professional is making 500,000, but they don't live off of 500,000. They could leave, they can usually typically incorporate and they leave an amount in their corporation, let's say 200 grand or 300 grand. So they only live off of the leftover, okay? So what do they invest in? Stocks, maybe some real estate. The problem is there's high taxation on the assets, okay? They have high taxation, so that's why they incorporated. So one solution is IFA strategy. An IFA strategy involves insurance and involves the bank over here. Well, what's the goal? To amplify the returns, reduce taxation, and to eliminate the estate bond. So oftentimes, it's not the simplest strategy. So often what we need to do is we need to highlight where the tax savings is. So this is the status quo. Let's say this person is leaving 300 grand a year inside their corporation, and they're going to invest it for the next 10 years just as a sample, okay? Let's say they're getting a 7% return. This is what's going to happen. 300,000 over 10 years, growing at 7%, is going to make a little over $3 million. And then if you leave the money in it, let's say for another 40 years, because I grew this thing up to age 50, my assumption was this person passes away in their 90s, will grow to $66 million. So 300,000, basically $3 million investment over 50 years grew to $66 million. Now, the capital, there's going to get double taxation. One, they're going to get taxed on the capital gain. So the 66 million, once it gets taxed, will only become 45 million, but it's still stuck in the corporation. Then they got to pull it out, usually in the form of dividend. They'll lose another 11. So by the time the 66 million comes out, they'll only see 33 million. So they've lost pretty much half of it just to taxation alone. So this is why you need tax planning. You need some form of tax planning in order to get the money out. So they just changed the rules, so we adapted the slide because, of course, now the reason why the taxation is so high is because we've implemented the new tax rules. Instead of 50% of the capital gain coming out in CDA, now only 33% is coming out due to capital gain. Okay. So you're going to net 33.4. If we implement IFA strategy does this. It basically invests leveraged money. So the 300K is actually being invested in an estate bond through an IFA strategy, and then it's being leveraged back out immediately into the stock market. So you're putting the money in, then leveraging it back out. Putting the money in, leveraging it back out right away, okay? Now, first of all, the client has to be okay with leverage because there's interest rate risk. Because over 50 years, you're not sure which way the interest rate, so usually we do sensitivity analysis to see. So the money goes in, we leverage it back out to the stocks or the real estate that they would have done. But what it's doing is it's creating CDA credits. That's what it's doing. It's creating a CDA credits, and the kicker is you'll also have this huge death benefit. So if you leverage the money back out, you haven't used up all of your credits. So without going through it with a fine-tooth comb, let's just jump to the end. Your 64 million has now turned into 43 million, and then by the time it gets taxed, again, you'll only get 37 million, but you have leftover 20 million of, 10 million of CDA credits. Here, you have this $38 million death benefit that your corporate estate bond has purchased, but it also has the leftover 10 million. To make a long story short, you have a $41 million improvement, making you net of 75 million versus your net of 33. So does the strategy work? Under certain conditions for most incorporated individuals who are able to leave the money in, yes, it works very, very nicely. Should it? But the thing is, the problem is, the bank's got to qualify you. So there's a bit of a stumbling block over here. So this over here is a great problem to have, but still a problem. So what I thought I would do is I would share those two strategies really, really quickly. And by all means, if anyone is in this predicament and they wanted me to go through it with you, anyone online, I'm happy to go through it just to see if you even qualify. So what you find over here, what are you giving up? Is there a catch? And the catch is liquidity in the first 10 years. You're not as liquid if you need the asset, which is why the bank qualifies you. They got to make sure that you're not suddenly going to run out and need this money. So there is a loss of liquidity in the early years, but then it's kind of hard to see. But the IFA strategy is significantly better basically after the first 10 to 12 years. The IFA strategy is even better on the liquidity side. But for the estate side, it's kind of hard to see, but it's better every single way. So if for some reason you were to pass away early at any given point, you were way better off with the IFA strategy because of the CDA credit and the death benefit. So if anyone, again, was in this predicament or you had high income or you were leaving along the corporation, what you should do is an evaluation to see if you even qualify for this strategy. But for most people, if you qualify, you should probably do it. So usually what we do is we go through the status quo, and then we take a look at how much of an advantage the IFA strategy is, and even each price point. One of the things you realize, see, like I said, in the early years, the liquidity is not as good in the first 10, but after about the 12 year, it's significantly better. And then, of course, at the very, very end, it's significantly better. So this is a great way to preserve wealth when you're passing it on to the next generation, and it's a great way to exactly extract wealth from a tax-free perspective as well. Okay, I've created sort of a digital newsletter called, and I'm calling it "Break Your Wealth Ceiling," based off of the book over here. So what I want to do is I want to highlight, and I'm going to talk to Cameron over here because maybe the Princeton property is one of the ones I'm going to highlight. But what I want to do is whenever I send it out once a month, I want to kind of talk about like a featured investment. Now it might be in an area that you're familiar with, and might be in an area that you're not familiar with. I've already been doing this with my clients, but now what I want to do it with basically other people, helping them to attract them to my financial practice. So it could be a residential, it could be a commercial, it can be in a brand new area you've never heard of. But this idea of saying, should we be investing in real estate? And the answer is yes, but where? But where? So I encourage people to sign up for my newsletter, and at the end I'll have a QR code. And essentially it's free. All you want to do is I'm going to try to give you market opportunities and also a market update. Plus I'll always have like a featured investment inside there. Plus it's a great way for us to basically stay in communication whenever I see opportunities in different areas. So this over here would be an example. Now, unfortunately, this isn't available anymore, but about a year and a half ago, this was kind of one of our featured properties over here. Now, I'm not going to give you the address, and I'll tell you really quickly, it's not even in BC. But this over here was in a province where they didn't have Airbnb restrictions, and it was an area that was very, very popular for Airbnb. It was a $600,000 house, but you could chop it up, okay? So what we did is we're creative with real estate. And what we want to do is we want to try to get as much cash flow out of it as possible, such as seeing if it can Airbnb. Now, of course, Airbnb is a lot of work, which is why we don't want you to do that work. Our team would also help to usually we have people in different areas that already have an Airbnb property manager or a regular property manager. Or if you needed something like, okay, me buying this house out of my area or out of even the province, I don't know what I'm doing. Well, wouldn't it be great to have a financial advisor that did know what they're doing, that already had teams out there, to set them up with the renovation or set them up with the property management or to set them up, possibly even with the financing out of country, right? But you're not going to find anything like this even close now. We're looking at a cash flow of over $2,000 per month if the Airbnb model, and of course we take into account the vacancy as well as the property management. It's got a cap rate of 10%. Those who understand cap rate, we know that even 5% is great, 10% is outrageously great. And then whenever we compare any form of real estate decision to an investment in the stock market, we always look at the ROI. In real estate, we call it IRR, is the internal rate of return. So this internal rate of return would be around 32% if you exited out of 20 years. And the way we do our calculations is we're always very transparent with the assumptions, because when we're showing the client, they want to say, where did you get these numbers from? What were your assumptions? And we walk them through. What was the down payment? 20%. What was the interest rate at the time? 4.5. What's the loan on the amortization? 30 years. What do you project that this thing is going to capital appreciate at? Only the 3% capital appreciation, because this was outside of BC in an area that we felt it would only grow at about 3%. But when people see our assumptions, then this is what an informed decision looks like. It'd be good if you had an advisor that can help you on an informed decision. What does the exit look like? Depends on the year. If you exit it out of year 10, that's how much money you're going to make. That would be your annual rate of return. If you exit it at year 20, then the numbers keep going down. So what we want to do is we want to be very, very transparent with the way we do analysis. So my background is in math, and so I've always liked the analytical part of the decisions that I help my clients to make, because these are, these opportunities are there. They're not there every single day, but they're definitely not, they don't come around once every 10 years. No, they're there. You just got to be working with the right team to find them. So again, break your wealth ceiling kind of helps people. I kind of wanted it to be very similar to Rich Dad, Poor Dad, which many people have read, including myself. But my story looks something like, it's not Rich Dad, Poor Dad. It's more like Rich Uncle, Not So Rich Dad. Where you had my father, who did a lot of the traditional things, but never really accumulated a ton of wealth. Where then you had my uncle, who basically invested in real estate as soon as he was able to, and then kept leveraging and then building it, and then helped to show me. And so what I want to do is I kind of want to act as that person who's going to enlighten you that there is another way to create wealth besides the stock market and mutual funds. And it's a better way. You just have to understand it, and you have to understand the math behind it. So I do encourage people to get a copy of this book. So what's our process if someone was to work with me and my team? We always start with a discovery meeting, because it's free. It's complimentary. It's just me trying to get to know you, and you trying to get to know me to see if there's a fit. And if there is a fit, then we move forward into figuring out how to implement a strategy for your specific scenario. We work on a fee-for-service basis in many cases, because we don't want to interrupt something that's already going well. So if you have a relationship with an investment advisor at the bank that you've been with 20 years and it's going well, we don't want to interrupt that. But you might need us on the real estate side because they're not helping you there. Or you might say, no, I'm looking for a financial advisor. I've done everything on my own, but now my finances become too complex. I might have too many properties and I'm not sure what to do with it. Should I sell? But wasn't that one of the mistakes? Should I buy more? But I don't want to buy the wrong thing and I can't find a good deal. Well, and how can I minimize the taxation? That's the type of area where we start to get involved with, where people have accumulated all this great wealth on their own, but now it's become beyond their complexity to figure out what to do next. So if you did want to try to set up a discovery meeting, then again, I'll share how you could connect with us near the end there. But realistically, what we try to look at, much like a physician, we try to look at your financial health status, like where are you right now? And if the answer is strong, it's, I've got my retirement, I figured out how I'm going to help my kids, I figured out how I'm going to pass on generational wealth, all of those other things, then we can assess that. Now, if it's not strong, we could also assess that and say, here are recommendations of what you can do in order to get you into a better position. So what I'm going to do over here is I'm going to sort of pause to maybe answer questions. And then for those of you who are listening online, there's the QR code, how to set up to book a call. And there's the QR code where if you just want the newsletter, just fill in the QR code and in the comments just say, can I be added to the newsletter? We like to give a couple of copies away for free. Here, everyone in the room will get a copy, but we usually release 10 copies to the first 10 people who reach out to us. So if you'd like, if you don't want to buy a copy off of Amazon, then the first 10 people who basically sign up for the newsletter, and if you sign up for the newsletter and you said, oh, can I also get a copy, the first 10 people will mail you a copy over there. And then the rest of you got to buy it online. But I've attached my email address as well. Just a quick heads up, it's my assistant who monitors my email. So what she does is she kind of filters the people who want to meet, answers any quick questions, and then sets up a time for us to meet. So it's September now. If we were to meet, unfortunately, you might have to wait a little bit just because our schedule is getting a little bit full. But we will meet with you eventually as long as you're patient. But I'll leave this up here, but now is a great time for questions. Does anyone have any questions about anything I've discussed up until now?
Any questions? And again, in the chat as well, you can drop questions
That's right.
live.
That's right, yeah.
In that strategy, are you talking about the participating whole life? Is that what you're...
You can't, yes, that is one of them that could do. You could do it through a UL as well. The only thing about the whole life is that the banks like it because it's significantly more secured, whereas the universal, it can fluctuate. But the one thing, like specifically with the IFA strategy, whole life has gotten a bit of a bad name just because it has very, very, very little cash values in the early years. It's sort of in the end, and then you get this big death benefit. Now there are new products specifically designed for the IFA, where just to throw out some loose numbers, in the old days of the whole life, you'd pump in, let's say, $300,000, and then the cash value would be like $40,000 in year one. Now we're looking at products with you pump in $100,000 and you could leverage out like $280,000.
Can you overfund as well?
And you could, yes, yeah. So that's why we like it as a product, because we're actually, able to leverage out up to 90, even in some cases 100%, while keeping it in force. And these are like, when I say these are like new to the last few years, where they're specifically designed for this, which is why I don't like to use the word whole life so much, because right away sometimes people tune out. Whereas when I kind of leverage it and have them understand it as a state bond, well, what's a bond? It yields a dividend. What else can I do with a bond? I could cash it in and it's worth a value. What else can I do with it? If it's a state bond, I could leverage against it. Yeah. Yep.
It's a whole life strategy. The idea is that once you have your corporation, then corporation is going to fund the policy, and then the beneficiary could be your children or your spouse. But then the assets, do you usually advise them to have the assets in the corporation, or would you have a separate holding company to own the assets?
Sure. So the question is, where do you put the strategy? Where do you put the estate bond? So a CDA credit only applies to corporations. So you can't. There will be no CDA credit if you try to do this personally. And if you have a holding company is a corporation. A lot of people have an operating company where they'll earn money, and then they could have a sister holding company where they transfer it tax-free to fund it. Usually you want to hold it in the holding company. Now if you have an operating company, but it will act as a holding company when you retire because it has no value in it, then oftentimes you could hold it in there as well.
Would you ever advise anybody who wants to turn their principal residence into an investment property, so they will sell it from personal name to a holding corporation, so that way there's no capital gains? Would that be one strategy that you can
Yeah, so the question is, can you transfer your personal residency into a corporation in order to bypass the capital gains? So the quick answer is you want to talk to an accountant, but from my understanding, you cannot do that. From my understanding, otherwise everyone would be doing it. But you want to double check with an accountant, because I believe once you put it into the corporation, then the corporation is not a person, which means it does not have a primary residence, which means it is subject to capital gains.
So you have to sell it to your corporation, so that way it's no longer your principal residence. So
But there will be tax implications, property transfer tax. You'll still technically own it, but you might want to explore a bare trust strategy.
Yeah.
And there are other strategies besides what you're saying that might be even more tax efficient. Yeah. But that's what I mean. I don't want to give any direct advice. You take it, come back to me, and then say, Christian, it was the wrong advice. You want to involve professionals. But that's a great question. But you're thinking in the right direction now. You're definitely thinking in the right direction. Okay. Was there any other questions? Any online?
No, I think clear as mud, right, guys?
Yeah, well, that's perfect. Well, what I'd like to do is, thanks. And for those of you live audience, by all means, grab a book on the way out. And for those of you who want to connect, feel free to do so. But sign up for the newsletter, because it's good market updates.
Awesome. Well, I appreciate it. Thanks so much.
This was
Thanks for
fun.
coming out.
This
I'll
has
grab
been
the
fun.
mic there from you as
Okay.
well. There we go. And again, you know, this is exactly what we were talking about today, just bringing you guys some different kind of thought processes towards investing. Because, you know, a lot of times when we're talking about, you know, standard buying a property, renting it, cash flowing. So as it's becoming a little bit more difficult for some people in our market today, we got to start thinking outside the box. We got to start thinking other opportunities out there. But at the end of the day, the biggest message that, you know, I really resonate with when you look at everything that we just saw, the number one message is go buy real estate. It's just where and what are the numbers, right? That's what it really boils down to. So again, thank you to our amazing speakers tonight. We're going to wrap things up, so feel free to grab your phones. We've got some QR codes for you as well. First one, obviously, is scan here for our social media links. Feel free to follow us on social. We're on all the things, Instagram, Twitter, YouTube, everything like that. Again, it would really appreciate it if you would subscribe to my YouTube channel as well, where the live recording of this does stay. You can also go back and watch all of our past live events as well. So all you have to do is go to youtube.com/cameramanning, hit the live tab. You'll see like videos, shorts, live. Go to live. And if you're sitting there saying, what did Christian talk about when he was doing that example? You can go back and rewatch that entire section now there as well. And obviously the subscription does help the channel, helps it grow, and helps get more eyes on it as well. And again, another QR code, join our Investors Performance Group Facebook page. This is where we post upcoming events. This is where when articles come out, we sometimes post it there. I once in a while go live on it. And again, we're trying to build up a community, so feel free. If you've got deals that you're looking for partners on, or you're looking for advice, or you just want to have a chat with what's going on in the economy, feel free to drop it into this group, and we're happy to build that community around you. And then lastly, our next event is going to be on October 17th. So make sure you guys let everyone know about it. Make sure you guys mark it on your calendars, and we'll see you then. That basically wraps it up for us here tonight. We're a little ahead of schedule because we had a cancellation of one of our speakers. We've got more food, we've got more drink, and a good time to chat with our speakers, get to know them a little bit better, and thank you very much for coming out. And those of you guys who are live as well, we appreciate you guys joining us, spending your time. I know a few of you guys are actually from out of province and out of state, so thank you so much for your time tonight. We hope you guys enjoyed, and we'll see you guys on the next one.